And what do you recommend as far as, so with growth equity, a lot of people think that there's a lot of modeling, right? So with your guys' fund, going late stage, do you have to put together a lot of, models, just kind of modeling out the returns probably, 3 to 4 years out because it's much more late stage? And I guess as far as the skill sets on the quantitative side, what are some that you think could be helpful for people to refine if they want to get into growth equity?
Yeah, there are two types of growth equity
Hmm.
investors, really. The growth equity investors that are really, PE shops
Yeah.
that do high growth companies, and they have the same underlying, plumbing as a PE shop, where you got to be like a banker and then be an analyst and then move up, move up to MD and go that route, and that's very heavy in in modeling. You have to go
Yeah.
professional route. Ours is we have a very interesting model. I think we have a great model because we um, follow what I would say is the most data backed thesis for venture outperformance, and that is the hot hand effect. It's when a fund in venture does really really well, like for example, they are first quartile, in performance in one year. They're actually more likely. They're actually more. So they're 40% likely to return the next fund in that top quartile versus the 25% chance you would expect if it were just random. And a lot of other asset classes are, just random like that. It's called performance persistence. Mutual funds, picking stocks, even private equity buyout funds. The research says that overwhelming amount of research says that venture funds, with the hot hand effect, are probably the best bets in finance. So if you can find access to a venture fund that has done extraordinarily well, um, then you should either join that fund, you should invest in that fund, you should find every deal that fund is doing and try and put your money in that deal,
Mhm.
because it's the best bet on Wall Street. So a lot of our model relies on finding great lead investors who we
Sure.
can trust to have an unfair advantage in writing and underwriting deals. So we use a lot of the leads work in order to. So a lot of our business is finding what's going on
Sure.
and convincing people to let us into those deals. We can't
Got
do it
it.
for free. So our model is interesting. We usually will pay carried interest like an
Yeah.
LP.
So is it an SPV that you guys pay into? Do you have to pay the carry and
That's right.
management fee? Okay. Got it.
We typically don't pay the management fee, but
Got it.
we have a cool niche where we will help earlier funds, like early stage funds,
Hmm.
follow on in their biggest winners by helping them fill their pro rata. There are some funds that, for example, were a $6 million fund and that we worked with a couple of years ago. They invested in a company now, Coupang, that did phenomenally well and is going to IPO, I assume, sometime in 2021. They A couple of rounds down the line after that early stage fund invested, their pro rata was larger than their entire fund.
Yeah.
And they
You
couldn't
mean you
possibly.
mean the amount that they had to pay to maintain the ownership
That's
was
exactly
larger than the whole fund. Got it.
right.
Yeah.
So something like 95% of pro rata globally expires. These people have these exclusive rights to invest in
Yeah.
these rounds to avoid dilution, and
Sure.
most of the time they just say no.
Hmm.
Uh, Especially the smaller funds that can't find access to capital.
Yeah.
They don't want to go through the process of going out and selling extra supply their
Yeah.
investors. So
Do
we
they
try and
make up for it real quick, Jesse? So do they make up for it though with the step up in valuation? So right, they're investing early, and then obviously they invested when it's 10 million, and then 2 3 rounds the company is worth 40 million, right? So there's a step up in valuation. So
there is.
even if they don't reinvest and maintain their ownership, do they still kind of make up for it with the valuation? And if they do, is it, I guess, not as attractive as having the pro rata? I guess is that the issue, that the step up is just not big enough or high enough to be meaningful? That for them to make it meaningful, they have to get the pro rata. Is that usually the problem, or is it just kind of icing on the cake to kind of improve the upside?
I would say it's icing on the cake. I
Okay.
would say that funds don't follow on for a million reasons. Maybe the valuation concerns. Maybe they don't want to deal with the hassle of administrating. Admin of
Yeah.
hosting an SPV. Maybe they just don't want to sell that
Hmm.
to their LPs, and sometimes the LPs just don't have that much money to put an SPV in it in any way, or they take too long.
Hmm.
But you raise an interesting point. That isn't it. Doesn't the initial investor do pretty well anyway? Yeah, they
Yeah.
do. But imagine you had 5 million pro rata rights to invest in a
Yeah.
great fund, and you only wanted to exercise one for any reason. That 4 million in extra access is very valuable.
Sure.
Folks like me and Alpha will come in and buy that off of you.
Yeah.
Those are rights that those funds will throw away as trash,
Hmm.
that are scarce and provide, like I said, a lot of them provide some of the best bets on Wall Street, and they're throwing it away. And
Sure.
we can come in some of these great companies like Wish, Vroom that just IPO'd,
Yeah.
Hoopla Asset, Coursera may IPO soon, Row Health may SPAC in a little bit. Some of these great companies, Udemy, Doctor on Demand, we can come in when they're great leads,
Hmm.
great lead investors, where we can take advantage of that hot hand effect. We come in and we try and make sure that the valuation is fine, just a couple of checks. Make sure we pick one thing like market value or valuation, and we go a deep dive on that just to make sure that we're covering all our bases.
Hmm.
And that's why we can move very, very quickly. And that's
Sure.
why our product is pretty, I would say, valuable to early stage.
And to clarify, you're picking it off of the early investors that just are too small to be able to afford that pro rata, but you guys have a little bit of capital that you can come in and take that off of that. Not really take it off of it, but take advantage of that remaining, let's say 4 million pro rata that is pretty much more than half of the whole $6 million fund, right? But if
Yeah.
you guys can come in, you get that massive upside from the maintaining of ownership, right?
Right.
Just want to make sure I'm getting it right.
We'll tend to split carry, so we'll pay a 10% carried interest,
Okay.
sometimes above a 2x hurdle, uh,
Yeah.
depending on the deal. But that $4 million, where that early stage fund was just going to throw it away, now there's basically a warrant
Hmm.
for that GP, that if that fund does really well, not only they're going to get access to what they've invested from their fund, they have a very, very nice additional upside sweetener from us as a thank you for giving us access into the deal. And they also keep their pro rata for the next round. So like we got into Lime Scooter,
Hmm.
with help from a very large $1 billion fund. They wanted into the round. They actually wanted the pro rata for the next round, but they didn't like the valuation on this round. So they let us take it. They got the extra upside without any real downside risk, because we take that risk on. We pay carry, so if the deal doesn't do well, we don't pay any carry.
Yeah.
But they don't pay us anything. And if they raise again, we don't necessarily get access to that pro rata. So they get to keep it, and they get the optics of following on, because oftentimes funds will follow on in their investments because not following on is worse.
Yeah.
It looks like, oh, I saw the financials. I know the company very well. I know the team. I see the valuation, and no, thank you. I'm not interested. That
Sure.
sends a terrible signal to the market. So funds are often handcuffed, and they are forced to come, and being dragged into a round. But we can come in and make it look like you followed on. We're happy to sneak below.
Yeah. So it's kind of like a white labeled service where it's you're buying it and you're underwriting it, but the branding and the optics look like it's coming from that fund, but you're kind of, it's almost like a white labeled service, I guess, right? Because
Yeah.
yeah, I mean, I don't know if anybody uses that term, but that's kind of the way I see, because you're allowing them to get access behind the scenes, I
That's
guess.
exactly right.
Yeah.
Exactly right. It's a cool model.
Yeah. And is this your core business, or is this just one of the strategies that you guys have alongside the traditional direct investments, or is this kind of your secret, you know,
This is our
main
business.
strategy? Yeah.
This is our business. It's our
That's
niche.
great. Yeah.
And we are raising our third fund right now,
Sure.
and we're
So it's
targeting
a proven model, pretty much.
Yeah,
Yeah.
people are willing to pay us management fees and carried interest to do this business for them, because we've shown that we have the we have the access, and we have the, I don't know, we have the operation. And as long as people are willing to fund our funds, and the fund's doing quite well, then we are going to continue to try and provide the service to our LPs. It's exciting, and we're obviously going to try and evolve as we can. But the market is saying that we're doing a good job, and we should continue to keep going.
But it looks like
Sure.
Sean's got a question. He turned his
Yep.
phone on.
Yeah, Jesse, I did have a question. First of all, I think the story of you getting into ventures, like, I think for a lot of us in this room, like, hopefully I could speak for some other people, it was really inspiring, I thought. And it's like, feels like it's applicable to a lot of, the people in this room who are just trying to, break in really any way they can. So I appreciate you sharing your story. I had a question on the hot hand strategy that you talked about. It's a twofold question, so bear with me here. The first part is, you're saying, it's one of the best bets on Wall Street, to kind of follow these firms that have the hot hand, try to get in on their investments. What is the data behind that? Like, is there actually like a study that's been done, and is there like something written up about it? And if so, like, what do those returns actually look like?
Yeah. So glad you asked that, because that's so. When I was a broker at Morgan Stanley, I'd be selling stocks and bonds, and everyone who was making a lot of money was saying, "Oh yes, sell this, buy that," and the data constantly shows that stock picking is very, very hard. In fact, impossible most of the time to make it to be consistently outperforming, the average stock. So I'll break this down or whatever. Nanda, Samila, and Sorensen, 2017. Let's see. HSU 2004, Sorensen and Stewart 2001, Huckberg et al. 2007, and a brand new one came out. Oh wait, a brand new one came out. Kaplan et al. 2020 is one that's the most recent. Kaplan et al. 2020, the performance persistence of venture capital returns. It will shock you the way it shocked me. I think the data that I quoted earlier was from that 2020 report. If you return in the top quartile, you have a 40% chance of returning in the top quartile in the second fund versus a 25% chance you would expect if there were no performance persistence. So everything else kind of falls in line. Like buyouts are basically 25%, mutual funds 25%, hedge funds are 25%, more or less. There's a little bit of persistence with hedge funds, but it only persists for about a quarter, and you can't get in and out of a hedge fund in a quarter. So essentially, venture capital funds that have returned top quartile, as far as I am concerned, as far as I've seen the data, and I spent way too much time looking this up, that's the best bet on Wall Street. In terms of other strategies for co-investors, I mean, what I've seen is it's really stock picking at that point.
I was about to say too, by the way, if your strategy's, working as well as it's working, like, that's why I was like, if you don't know any other ones because you don't practice any other ones, that's fine with me. This one seems to like really be backed up by some real data. So like, I don't blame you.
Yeah, thanks. And as long as we can keep doing it and making money, it makes a lot of sense to me. And I'm very lucky that I ended up here because I also kind of believe in the product. And if I didn't believe in the product, you guys would know it pretty quickly.